Welcome to Lesson 8, How Life Insurance Agents Are Paid. In this session, we'll pull back the curtain on commissions, incentives, and the questions you should be asking to protect your best interests. Welcome back. In Lesson 7, we discuss the valuable role life insurance agents can provide. They help people calculate their needs, compare policies, complete applications, work through underwriting, and maintain coverage after the sale. Agents deserve to be paid for that work, but as a consumer, you should understand how they are paid and whether the compensation could influence the recommendation you receive. This does not mean you should distrust the agent. It means you should ask clear questions before making a long-term financial decision. Many life insurance agents are paid through commissions. When you purchase a policy, the insurance company may pay compensation to the individual agent, the agent's firm, a brokerage organization, or a combination of these parties. You normally do not write the agent a separate check. The commission is paid by the insurance company from the overall financial structure of the policy. That does not mean the service is free. The insurance company considers selling and distribution costs when it sets premiums, charges, and policy terms. The largest commission is often paid during the first year. Suppose a term or permanent policy has an annual premium of $3,000. If the gross first-year commission is 80%, the agent's firm could receive approximately $2,400. But the individual agent may not keep that entire amount. The compensation might be divided among the agent, the agency, a brokerage, or a general agent. The agent also pays for office expenses, staff, licensing, training, marketing, and customer leads. Gross commission and take-home income are not the same thing. Agents may also receive smaller renewal commissions when the policy remains in force. These payments may continue for several years, depending on the product and the agent's contract. Renewal commissions can reward agents for placing coverage that clients can afford and maintain. They also help support ongoing service, such as beneficiary updates, policy reviews, billing questions, and conversion requests, or help during the claims process. Permanent life insurance policies may use something called a target premium. The target premium is an amount the insurance company uses to calculate commissions. It may not be the same as the amount the policy owner actually pays. For example, an indexed or universal life policy might have a target premium of $10,000. The owner may choose to pay more than that amount to build policy value. The commission on money paid above the target may be lower than the commission paid on the target amount. This can make compensation difficult to understand. Because of this complexity, it is vital to ask whether the commission is based on the actual premium, the target premium, or another formula entirely. In some cases, the gross compensation connected with a permanent policy can exceed 100% of the first-year target premium. If the maximum gross commission is 110% of a $10,000 target, the total compensation paid to the selling firm could be as much as $11,000. Additional bonuses or firm-level incentives may also apply. That does not mean the individual agent personally receives $11,000, but the size of the compensation creates a possible conflict that the buyer deserves to understand. Commissions are not the only form of compensation. Agents or firms may also receive production bonuses, agency overrides, marketing allowances, conference qualifications, salary, and employee benefits. These incentives do not automatically make a recommendation wrong. Most businesses reward people for strong performance. The important question is whether the recommendation serves your need or mainly serves the compensation opportunity. Agents may also face chargebacks. A chargeback occurs when a policy is canceled or lapses soon after it is issued and part of the commission is taken back. This gives the agent a financial reason to place a policy that the client can afford and is likely to keep. Different policy types may pay different amounts. A basic term policy may pay a smaller dollar commission because its premium is relatively low, while a permanent policy may create a much larger commission because its premium is much higher. For example, a $1 million term policy might cost $800 per year, while a permanent policy with a much smaller death benefit might cost $10,000 or more. Before purchasing a policy, ask these questions. How are you and your firm paid? What is the estimated first-year compensation? Will you receive renewal commissions? Is the commission based on my actual premium or a target premium? And will your agency receive an override or bonus? Would you be paid differently if I selected another policy? Would a lower cost term policy meet the same protection need? And will you provide ongoing service after the sale? These are fair and reasonable questions. A trustworthy professional should be willing to discuss compensation without becoming defensive. A high commission does not prove that a recommendation is bad, and a low commission does not prove that it is good. Evaluate the full recommendation. Does it solve a real financial problem? Can you afford the premiums? Do you understand the risks? Were reasonable alternatives considered? Now turn to the compensation disclosure questions section of your workbook. Before meeting with an agent, write down the questions you want answered. For each proposed policy, record the premium, the estimated commission, any renewals, and whether bonuses apply. Clear information helps you evaluate the recommendation with confidence. In Lesson 9, we will look at advanced uses of life insurance, including irrevocable life insurance trusts, premium financing, and business-owned coverage. I'll see you in Lesson 9.